Hi everyone, welcome to video 2. This might be our shortest video on record. This problem is on page 828, problem 1521b. And this is like your first lab problem. You'll be happy to see how short and easy it is. And that lab problem that you have is 1518a. It's very straightforward. It's easy to do. So, as you can see, I pre-wrote it while it was up here, so it's not as neat as the ones I do sitting on the floor for you, like you'll see in the next video. But let's take a look. This is, suppose Hale & Sons purchases $800,000 worth of 3.5% annual bonds. Remember, they're always quoted at the annual rate, even when you're the purchaser, which means you get half of that, 1.75 every 6 months in interest revenue, of Tyson Way Corporations at face value. The best thing about Chapter 15 is nothing's purchased from other corporations at a discount or a premium like you saw in Chapter 14. Everything's bought at face value, nothing to amortize. It's very much straightforward with the price, and you don't have to break up the discount or premium. Not at this level anyway. If you go on to more advanced classes, you do have that, but it's not bad. It's just like what we did in Chapter 14, except we're the ones that have to raise and lower our interest revenue if we have a premium or a discount, but you don't want to know about that right now, right? Okay, it's not too bad. The bonds pay interest June 30th and December 31st, just like it usually is. Every year, and they will mature in 5 years at December 31st, 2022. They intend to hold this investment to maturity. So it's a held to maturity debt investment. It's a bond, okay? We see we have a mix here. We have some debt and some equity. The next video, video 3, is going to be about equity investments. So they want us to journalize the transactions related to the bonds for 2018. Okay? That sounds kind of intimidating, but there's really only 3. The initial purchase on January 1st for $800,000. Remember, they bought at face, just like everything in Chapter 15 is bought at 100% face amount. Held to maturity debt investments is debited. Okay? Again, we don't have to name it when it's held to maturity. Cash is credited for the $800,000. So we know we're going to get 2 interest payments, 3.5% in half. In the book, they do 6/12. I do 1/2, same thing. Or I just break it down myself and multiply by 1.75% or 0.0175. But if you don't like to do that, you can do 3.5 times 1/2 or 6/12 is the same thing. Anyway, it comes out to $14,000 that our company, we're the company in this problem that's getting the interest revenue, we're going to get $14,000 every 6 months in interest revenue. And if we had to do all 10 of them, because it's a 5-year bond, they would all be done the same way. Just like in the last chapter, but we had the amortizations to worry about. We don't here, so easy peasy, right? December 31st, we had our second interest payment from our investee. Their name is Tyson Way Corporation. Paid us again. Cash would be debited for the $800,000 times the half of 3.5% or 0.0175. 14,000. Again, all 10 would be the same. Interest revenue is credited. Now, the only other thing they want for requirement 2 is the bond's all done, and it's at maturity date, December 31st, 2022. And they're saying, okay, let's see the lump sum now coming to us, right? Nice and easy, right? The bond is fully matured. We get $800,000 in cash because we bought it at face, so we get our lump sum payment. We've gotten 10 of these, so we made $140,000 in interest revenue over the 5-year period. And we credit, because this is done now. We credit our held to maturity investment. Our bond is finished. We no longer have a bond related to this company unless we want to buy a new one. But right now we credit it because it's done and we have the money. So pretty good deal, even at only 3.5 a year, right? So it's a very good investment and companies take advantage. That is it for this problem. And again, this is like your first lab problem in the homework assignment, okay? The next one is a little longer, but I'll see you in a few minutes. Bye-bye.